say that you have one customer bringing you 55% of your revenue. Then what happens if he turns away? You might feel the urge, I mean, I understand I would, to kind of sugarcoat it, and it's the other way around. Investors love it when you say, this one we messed up. The investors will think, wow.
Business law is the most exclusive part of business, and we are here to give you exclusive knowledge for free. And as always, we have our business lawyer, Kat Strandberg, here with us. In each episode, we give you essential tips and tricks to help you build, protect, and grow your business with confidence. So, Kat, today we're going to talk about 8 different steps why the investor walks away.
8 reasons.
8 reasons.
Yeah.
And I mean, you are the lawyer. You see everything from the side of it, of investing and companies. What is happening?
Yeah. Well, when we talked about doing this episode, we said, well, how can we help? How can we contribute? So we talked, what are the main reasons that I've seen that makes a good deal, something that felt really good on the way, but then the investor decides to move away without really giving you the reason. So we're not talking about them saying that, okay, we don't believe in your valuation, we don't believe in the concept. We're talking about you have a match, everything feels good, you're in the middle of the due diligence, and then it does not work out.
And I mean, you have a lot of experience, many years. I guess you've seen a lot.
Many hours.
Many
nights. But let's kick off. So number 1, transparency. You heard us talk about it during the due diligence before. Investors, venture capital, savvy investors, they will expect that companies have flaws. That's not a problem. That's completely fine. But if they feel that they were not informed, that they have to do the digging and the pulling and find it out, that's a major turnoff. And I've seen many times when investors get cold feet because they feel that the founders were not transparent enough with them. Okay,
but what could the transparency be about? What do the business owners miss out on?
Oh, that can be anything. It can be questions about IP innovation, how the company came about. It can be relationships with former founders that walked away. Really anything that's a bit uncomfortable to talk about. And it's not about anybody trying to be dishonest or anything. It's just that you might feel the urge, I mean, I understand I would, to kind of sugarcoat it and put your best foot forward. And it's the other way around. Investors love it when you say, here's the challenges. This one we messed up. But then we did this and that, and now we're here. And we have a major issue in Japan where we're trying to do the tech development of something. But we think that if we move that to Taiwan, we can solve it. The investors will think, wow, that's transparent. You're realistic. You know that shit issues happen.
Yeah.
And you deal with it and you're upfront with it. So that's the difference.
I mean, it's the way to show your best side, to be transparent.
Yeah. Admit the problems and tell them how you solve them.
It's better.
Yeah.
So if you move forward, what other things did you see?
Well, a major one is, of course, protection of the IP.
Okay, tell me more about that.
If you're a tech company, you need to make sure, and even if you haven't from the beginning had all of the contracts with the consultants and with the employees, showing that you own all of the IP that's developed, you need to make sure that you hurry up and get a grip on it.
Okay.
And also, of course, make sure there's no copy issues with somebody else or anything like that.
Yes.
So that's kind of a big point, of course. And number 3.
Number
what do we
3,
have?
we're moving forward. Yes.
Moving forward quickly. Another issue that can be a major deal for bigger venture capital firms, that is if you have an unattractive cap table.
Okay, and what does that mean? First of all, what is a cap table?
Cap table, we're talking about the current ownership in the company.
Okay.
And unattractive, that can be that you have an angel investor or a venture capital firm with a bad reputation. Because they've done something unethical, invested in unethical companies, or branches. So anything that makes it hard for a professional, well-grounded, ESG-focused venture capital firm to get a connection with those other investors can be a problem. So even early on, when you're desperate for funding, make sure you keep the cap table clean and attractive.
Okay, and how do you do that? I mean,
say no.
Say no.
Yeah. Be a bit picky.
Be a bit picky, that's good.
It's easier said than done because you want the investments early on, but just know the name of the game.
Is it very common? Because is this something investor asks about early on, the cap table?
Absolutely.
It is?
Number one, I would say.
Ah, okay.
Yeah. And also, one thing I can add is that early on, when you're desperate for capital, do a bit of a due diligence on the investor. Look them up. Make sure you want them on the cap table long term, because it is like a marriage.
Yeah.
It might sound rosy and shiny in the beginning, but then issues might come up. So that was that number 3?
That was number 3. We're
Number
heading
3.
out to number 4.
Yeah. And that's keep your business and the company's business separate.
Okay, so me as a founder, don't bring in the private stuff?
Yeah.
What can that be?
Well, one thing, and I mean, that's okay, but you might want to bring your wife on the payroll, your cousin on the payroll, that house you own, you might lease it from the company really or something. So just be mindful and keep a level head so you don't have your whole family working in the company without that making a lot of sense, perhaps.
Okay.
Or you have some real estate connections or anything else.
That doesn't look so professional, maybe.
No.
Okay.
So that's it. So that was number 4.
That was number 4. Number 5.
Number 5. Well, that is early on, stay clear of making a financial mess of the cap table, of the ownership. Because if you have too many layers of preference shares early on, that can skew incentives and that can be off-putting for other investors. So be mindful about that, and also what kind of debt you bring on, and if the ones holding the debt, what kind of covenants, what kind of trigger points, control rights they have. So be mindful if you're in it for the long run, not to make it too complex too early.
Okay, so keep it clean.
As much as possible. And I'm saying that with a lot of respect, that every step is a step forward, and you're fighting for that finance, you're fighting to grow, but just know the name of the game, and it might come up and make trouble later on. So keep it in mind.
Okay, we're heading on to the next step. Number
6?
Number 6. We're at number 6 now.
The counting is the biggest challenge today, I think.
We're good at many things, but counting.
Yeah, indeed. So what do we have left? One thing that's a major turnoff I've noticed early on in the game is if you're slow in your responses. And that might sound like a no-brainer, but the VC industry expects you to be really hungry. They might even be a bit, you might call it foul play, but they might even test you on it. They might even send you an email Friday night to see if you respond, late Sunday with a complete explanation, with a new updated market plan or whatever. So show that you're hungry, show that you're quick on the responses, that you're eager to help out, you're eager to provide the information. Because the competition is fierce for the VC money.
Yeah, it is. We're heading out to number 7.
Number 7. And one thing, I mean, again, growing, hungry, you want your customers and your agreements in place. But a VC investor might be turned off if you have too much concentration of your customers. Because that makes you really vulnerable.
Okay.
So typically, the general outline will be that you will not want, say that you have one customer bringing you 55% of your revenue. Then what happens if he turns away? And this will depend on the industry, because you might be servicing countries or authorities. So they might see a clear growth path anyway. But a good rule to keep in mind is to not be too vulnerable in your contracts. So not too much concentration.
Not too much concentration.
And that can be for suppliers also.
Okay.
Yeah.
Okay, the last one.
The last one, and that is...
Be humble and stay clear.
Thank you. Because that is exactly what it is. A bit like showing that you're hungry. You're in the due diligence. It can be frustrating. Your confidence might get a bit of a push, really. So be humble. Get ready for annoying questions. Get ready to be questioned about your baby. They might call your baby ugly. No, and be professional about it.
Yeah.
Because that's part of the game, and that's okay. And the VC, they will invest in you because they believe in you. The VC, I mean, if you look at an M&A deal, you're selling the company. You're leaving it. You're paying forward. Sometimes you stay on, but the point is you're selling. You're leaving it. In this case, you're in the company. You're bringing somebody with you.
It's like receiving a guest.
Or even your wife. So it's a marriage.
Yeah.
So they need to believe in you. They need to like you. So be humble. Don't get frustrated. Keep a level head. Even if it's stressful and even if you get questions that you feel are unfair or they question your budget, your prognosis, your market plan, stay cool.
Stay cool.
Because they want to test you. They want to believe in you in order to invest in you.
Yeah. That's a very good tip. Stay cool. Because sometimes the energy or the feelings takes over.
Of course. You love what you do.
Yeah.
There's so much at stake.
It is. So we've talked about 8 different ways that the investor might leave.
Yeah.
And
that we've seen from the inside. So that's why we're sharing it now.
Yes. And very interesting because this is things, you don't think about when you're in it. I mean, it's easier to see when you look at it from the outside.
And just having heard it before, the classical, if you label it, it doesn't get as hard to tackle when it happens.
No, it's nice to know that it actually happened to other people.
And let us know your experience, if you've had completely different experiences, or if you want any tips and tricks about something in particular, we're here.
We are here. And that's why we're doing this. I mean, business law is the most exclusive part of business, as we always say, and we're here to give it for free.
Yeah. So this is knowledge sharing, never legal advice. That's on you.
Exactly.
Knowledge sharing here.
Yeah, it's knowledge sharing. And I really want to thank you for today's episode. And I'll see you guys again soon. And like and subscribe.
Bye.
Bye.